A recent study on the best performing stocks turned up some real surprises. At the top of the list was cancer stick maker Altria Group, and that's really no surprise considering how addictive their product is. But another company on that list has quite an addictive product as well. Of the 30 best performing stocks, just one energy company made the list, Exxon Mobil. Oil isn't going anywhere, and today we're going to talk about why we invested in Exxon Mobil and what the future looks like for the company. So there's this common belief that the emergence of electric vehicles is going to put a damper on the demand for oil, and various institutions have come up with estimates as to when we can expect to reach peak demand. So I think the average consensus is probably 2030, so let's say in 5 years. So this report by Goldman Sachs is quite interesting. It talks about how peak oil demand is still a decade away. What they point to is really interesting. So it's the fact that you're still going to have strong demand for oil coming from Asia. And if you spend a lot of time in emerging markets, as I do, you're going to see very quickly that oil is going nowhere fast. And in a lot of these emerging markets, you have new upper class of people, and they're all buying tons of products. And those products require oil, because oil isn't just about diesel and gasoline. We're going to touch on that. We've always thought that most of the world's population can't afford electric vehicles, but based on what we're seeing coming out of BYD, these electric vehicles coming out of China have a very competitive total cost of ownership. So they may be displacing some gas-powered vehicles in emerging markets. But what Goldman says is that even if the demand for gasoline peaks in 2028, that the demand for petrochemicals, the growth of that is going to more than offset the decline in demand for gasoline. And here you can see the breakdown that Goldman shows for each of these major categories. So you have transportation, which is gasoline and diesel. You have petrochemicals, and then jet fuel, and of course, the other category. And when you break down a barrel of oil, it's quite interesting. Here you can see the percentages. So what you have, around 70% goes for diesel fuel, heating oil, and gasoline, whilst the rest is used to make products like you see on the table here on the right. So oil isn't just used for car engines and gas tanks. Now, what's interesting about oil, as is all commodities, is the price is based on supply and demand. So here you can see just how volatile the price of oil is. I was around during this time and can distinctly recall the price of oil going up to above $120 a barrel and then falling quite quickly. And for oil companies, they're really trying to make hay while the sun shines, but you have some very difficult decisions to make there, because you can't start making investments under the assumption that oil is always going to be at 120 or always going to be at 40. So you have to try to find a happy medium there when you're doing your forecasting. When your business is dependent on the price of a volatile commodity, you better do lots of hedging. You better do planning for uncertainty. And you're going to see that in how Exxon Mobil lays out their strategy looking forward. The largest companies in the world that are producing oil, you can see them here on this list. Of course, you have the Saudis at the top, and then in second place would be Exxon Mobil. And when you look at U.S. oil producers, you see this list here, Exxon Mobil. This is taken from the popular energy ETF XLE, and you can see Exxon Mobil has a 22% weighting in that ETF. And when we invest in a particular niche, we always want to invest in leaders. In dividend growth investing, you're often investing in leaders because there's a lot of quality names in our universe. But Exxon here's shown that they're not only a leader in size, but also some key metrics. And the one that we're going to focus on today is cash flow from operations. Profit is an opinion, cash is a fact. Somebody asked what that meant, and it simply means that your accountants can do all kinds of things, but cash never lies. The cash that a business is generating that goes into the bank, you can't weave tales around that. So that's a very pure number to look at. So a healthy, mature business produces cash flow from operations. So you'll see a lot of these disruptive tech firms have negative cash flows from operations. They're running at a loss, of course, because all their capital is going into growing as fast as possible. But when you're mature, the idea is that you have a profitable business, you're generating cash, which you can then do a number of things with. You can give some of that cash back to shareholders in the form of dividends or share buybacks. You can invest in future growth today. Now, in the oil industry, that's kind of difficult because you have fairly long lead times, right? You got to go explore, you got to go find the resources, you got to get all the permits, you got to get all the equipment, stuff like that. And then how can you calculate return on investment for a volatile commodity. Volatile environments also need a cash buffer for bad times. So we would expect to see oil companies have a nice sized war chest that can help tide them over when the price of oil goes negative, as it did during the time of COVID. So let's look and see what cash flows look like for Exxon in the first 3 quarters of 2024. On the left there, you see year-end 2023 cash, $31.6 billion. And the table here also shows the numbers as well, so you can sort of follow along. It always helps to validate numbers from several sources so that you know what you're looking at. And what we're going to do is move to the right. So we have year-end 2023 cash. Then this green bar, cash flow from operations, $42.8 billion. That's a lot of money. Then they have some asset sales, $1.8 billion. And then they have capital expenditures. They're investing back in their business, right? So really good thing to know. Operating cash flows, or cash flows from operations, minus CapEx gives you free cash flow. That's after you've invested in your business, you've taken care of that. Then you've got money left over that you can do things with. And what a business will often do is give some of that money back to shareholders. Here you can see they've done that. So $26 billion. 12 of that would be dividends. The rest would be share buybacks. We're going to talk a little bit about whether or not that's a good idea. Then you have debt repayment. Exxon repaid something like $20 billion in debt in 2021. So they're staying on top of that, as they should, as we said, make hay when the sun shines, right? And then you see that gets them to the ending cash as of last quarter. And what is that? About $27 billion. In the table below, you can see that same number. So let's talk about where this cash is coming from. And this is their rather innovative business model. So you have upstream production. That's where you identify, extract, and produce oil products, the core product, right? Revenue for this segment, they describe simply as price times quantity, right? But then what Exxon does is they take that output, that oil that they might sell to people that would then turn that oil into products, and they sell it to their own refineries. So that's called downstream, and downstream refers to the activities of processing, refining oil products from commodities to usable products such as jet fuel, gas, and diesel. So they're the world's largest integrated refiner with ownership in 19 refineries around the world. So think about that for a second. If the price of oil has gone way up, then their upstream is doing really well, right? Price times quantity. So they're raking in the cash. But the downstream's like, man, we have to pay so much more money for this input product. We're not very profitable now. So that, see how it offsets now. If the price of oil falls, upstream's like, damn, we're not getting very much money. Downstream's like, wow, our input product is so cheap. This is great. So there's a natural hedge there. We love to see businesses with natural hedges. Then you have chemicals, and Exxon's actually one of the world's largest chemical companies. They take those refined products and process them further to produce both commodity and specialty chemicals, and they operate 16 large industrial complexes. And I think this slide here really gives you a good idea of the breakdown. So you have upstream, right, what we described, product solutions, that's another name for downstream, but then look here. You see under product solutions how you have these 3 components: chemical products, specialty products, and energy products. And what you can do is go into their financials, their investor deck, and look at all the details behind this stuff. It's really quite cool. So you can see where their strengths and weaknesses are. But there's also another component, the 3 segments that you see here, other being low carbon solutions. You see they talk about biofuels. Biofuels have been talked about for as long as I can remember as being this great thing, and they've just never really proven to be that economically viable, but this is still something that Exxon's focused on. And this chart here is very telling. It shows the breakdown of cash flows. Remember, we're talking about cash flows for each segment. You see what upstream, 68% of cash flows there, downstream, chemical, and then other, of course. So what Exxon plans to do, they have a 2023 investor deck where I pulled a couple slides from, and you see these step charts here. So they're going from the third quarter of 2023 to 2027. They talk about $14 billion of future earnings and cash flow growth over the next 4 years. That's from 2023 to 2027. And you see these green bars components upstream. So they're going to do all kinds of value add for the upstream. And then they have product solutions, right? That other segment. So both improvements on both surrounding things like cost and whatnot are going to result in a lot more cash flows being generated for the business, which can be used to increase the dividend. We'll talk about the dividend, but you see this chart shows that for upstream, structural cost reductions are going to help that earnings growth. And look at the assumption here, $60 a barrel. That's what they're making assumptions on. So they have to pick some price that they can forecast things with, and that's what they've chosen. And then what they'll do is a sensitivity analysis and take a look at $40 a barrel or 80, and then say this is what things look like at these price points. 90% of the oil and flowing gas investments that they're making, this is really interesting, are going to generate greater than 10% return on investment at less than $35 a barrel. That's pretty sharp. So even if oil does go down a significant amount, they're still going to be able to run profitable projects. And also they note here in 2027 that more than half of their production will come from competitively advantaged assets averaging $9 a barrel, earnings higher than their base portfolio. So that's good, right? They're only investing in highly profitable projects. An article by the FT not too long ago, mostly was actually several years ago, pointed to how Exxon was sort of pulling back on the reins when it came to spending a lot of CapEx and becoming a lot smarter about what projects they were taking on. Then the product solutions downstream here, you can see similar growth coming from structural cost reduction. So they've been doing that, I think, since 2019. And strategic projects, right? Investments back into the business, all that CapEx that's going in. Here's an example, a table that shows very concrete aggregate volume impact. So what they're doing, they're the project name, and what's the volume impact? What sort of products are coming out of this in quantities? When's the first full year of operation, and what's the earnings uplift from that project? This is really cool stuff. You can only imagine how complex this organization is. And I think some of the things need to be taken with a grain of salt. They talk about developing a leading position in lithium. Sure, that sounds good on paper, sounds very attractive, right? Will this ever really move the needle? And they talk about, first production in 2027. All right, this is a big company with a lot of revenues. I'm just not so sure that some of the projects that they think are going to be quite lucrative will be as lucrative as they think. But it all comes down to going back to cash flows, the amount of cash that this business can generate, and then what they're able to do with that. And here you can see the price of Brent crude oil at $50, $60, and $80, and the cumulative surplus cash flow that they'll realize at each of those price points. Break even of $35 per barrel in 2027. So there you are, right? That's the very important metric. They want to try to get that as low as possible. The cost of producing a barrel of oil as low as possible. And then they talk about going forward this share repurchase program, which they've accelerated. Now, there's a number of thoughts around this. You only want to buy back shares if they're competitively priced, if you're receiving value from buying those shares. And well, how do we tell if a share is competitively priced? Well, we look at the price to earnings ratio, and that's one indicator that we can use for a mature business. And here you see that plotted over time in yellow there, where it fell below 10 to around 8. That seems to be more in the historically low range versus where it's trading at today, around 14. So the bulls will say, well, they're doing this in advance of all those earnings increases that we're expecting. So really, the price to earnings will fall once earnings increases, whatever. Bears say, well, management's trying to pad their bonuses. For us, we just like to see dividends increase. So when we look at Exxon Mobil, the reason that we invested in this company is part of our Quantigence strategy. This is our Q-score calculator, and it shows filtered here on our core universe. We filtered on energy, and there's 3 names here. At the top is Chevron with a high Q-score above 20, Exxon with a lower Q-score of 17. Why is that? Well, it's being penalized. So we penalize 5-year dividend growth below, I believe it's 4%, and 10-year below 5%. And Exxon's being dinged on both. They're punished for those, so they have a lower Q-score. And Exxon didn't have these Q-score penalties when we invested in it, so we're keeping an eye on that today. The only reason we ever sell a dividend champion is they stop increasing their dividend, and Exxon Mobil seems in no danger that will happen. But when we look at recent dividend growth over the past 5 years here, we can see that in 2020, of course, when oil went negative, Exxon Mobil did a very prudent thing and just raised their dividend by a single penny. You see Schwab reflects this as a 0% raise, but we can see that it had a minuscule raise there so they could keep that track record. Here you can see that between 2023 and 2022, there was a 3.7% growth, and then this year there'll be a 4.3% growth. So that's accelerating a little bit, and there's a potential it could accelerate a lot more. So when we go back to that original cash flow chart, talking about the $26.4 billion in free cash flows they had, the $26.1 billion they returned to shareholders, and of that, just $12 billion was dividends. So their free cash flow payout ratio, if you will, is less than 50%. They've got some buffer there. Now, the dividend seems quite safe. Growth is sort of accelerating, but can they get back to 8% growth? Why do I say 8%? Because in our universe of dividend champions, our core universe, the average growth of a dividend stock in that universe is 8%. So we want to see any company we're holding around that average, ideally, with some exceptions, for example, like REITs or utilities that might grow slower. So energy is a sector that we definitely want exposure to. Exxon's a leader in this space, but we'd like to see a higher Q score than they have right now, which will come when they can increase that dividend growth or resume that. We'd like to see it in the 8% range. Plenty of free cash flow as expected, and based on the price of oil and their ability to execute certainly gives them some ability to enable bigger increases. But it's business as usual for Exxon. We'll see how they fare. I'm going to go ahead and leave you with a piece we did on Exxon versus Chevron. There's a lot of good information here for those of you that are trying to decide between those two large energy giants. Thanks so much for taking the time to watch this today.